Fundstrat out with a new note today says this. Yesterday's bullish reversal as growth starts to make a comeback. The S&P managed to get above 55.25 by the close, which turns short-term trends back to bullish. Momentum and trends have been negative in recent days, but Wednesday's capitulatory reversal does suggest that rallies might be likely into next week's FOMC meeting. And that's exactly what we are seeing today, with the S&P 500 advancing 1/3 of 1%. But really the shine today is on the Russell 2000 that is up 0.81%, over double outpacing the Nasdaq and triple the S&P. Now, if that wasn't bullish, if what we're seeing in markets does not get you excited, perhaps this will. Quote, from the inception of the S&P 500 ETF in 1993, there have only been 9 other occurrences when the index was down at least 1.5% at the lows and finished up at least 1%. In fact, the last time that happened was the exact low of the bear market in 2022 back in October. And typically when you get this kind of reversal, it is close to the end of either bear markets or corrections, and you do tend to make your way higher. With an average 3-month return of 5.1%, an average 6-month return of 9.4%, and an average 12-month return of 12.2%. with a median return of 16.1% 12 months later, and a positivity rate of almost 73%. So what we seen yesterday is very bullish behavior, where markets got bought up at the bottom and closed really positive. Now, in all fairness, it was Nvidia for the most part that sparked yesterday's rally, and it was 5 words. That's all it took. Nvidia's CEO Jensen Huang says, quote, "Demand for chips is great." And that sent Nvidia up almost 8% yesterday. So I think what happened yesterday is a little bit different looking at 2022 because of the concentration around AI, around Nvidia. The huge weighting that Nvidia and big tech have on indexes is a lot larger today than it was then, but I think the same principle applies. Yesterday was very positive for the bulls. But as we are heading into the first Fed cut next week, what will really determine if this market goes higher from here, if we see a broadening out, or if markets just crash, is the economic data. Now, we did get PPI today, core and headline. As I've said many times here on the channel, inflation's really not a catalyst anymore. We didn't see markets react to PPI today because it's not a catalyst. The Fed, rate cuts, and the economy is the catalyst. Now, CPI can be important if it starts to come in higher than expected, or if it starts to come in lower than expected into deflation territory. Because why? As I've said many times, if inflation starts to go into deflation territory, that is signaling economic weakness. So really, inflation doesn't matter in and of itself. The signals we get from inflation can be important, though. We didn't get any today. No signals from inflation. We did have core PPI that was revised lower last month from 0% to negative 0.2%, and core PPI came in at positive 0.3%. But when you're looking at a month-over-month basis, that's really not that bad. We were expecting 0.2% based on the 0% implied last month PPI rate. So month over month, you're actually still below estimates, believe that or not, if you take into consideration last month. Initial jobless claims came in a little bit higher than expected, around 230,000. We were expecting around 228,000 or so, but that really didn't move markets either. Tomorrow we will have Michigan consumer sentiment. We are expecting sentiment to get a little bit better, but what really matters is consumer expectations, expecting those to weaken a little bit, and current conditions. We're expecting those to get a little bit better. Now, if you were to see, consumer expectations or current conditions plummet or something along those lines, I think the markets would react to that. Vice versa. If things get better, I think markets will react to that. We also get some data out of China late tomorrow night: industrial production, retail sales, house price index, and fixed investment year over year. Also, the unemployment rate. A lot of people are looking at China and saying, how bad is China going to get? Is China going to be a contained kind of slowdown or recession, or is that going to spill over to the broader economic world? We don't know yet, and that's something markets will pay attention to. Now, next week, we have the first Fed cut on the 18th. That is on Wednesday. So the data that we get from now until Wednesday is very important. On Monday, we don't get anything. You have New York Empire State Manufacturing Index, but that's not going to move the needle as far as the Fed and what the Fed is going to do. Tuesday, we get retail sales month over month. Now, this is going to be a massive catalyst for probably the next 6 to 12 months at bare minimum, because the worry is the economy is weakening. So good news will be good news and bad news will be bad news. Last month, we came in at 1% positive. We are expecting 0.2% positive. That's not that impressive, but on a month-over-month basis, you were at 1% last month. That's actually pretty good for a 2-month annualized, 1.2% retail sales. That would be pretty good. Now, if this number comes in negative, then that can sway the odds of a 25 or 50 basis point cut coming the following day by the Fed. So really, in a nutshell, besides the data coming out tomorrow with Michigan consumer sentiment, that Tuesday retail sales data is going to be the biggest catalyst until the Fed. The question then becomes, after the Fed, we get a dot plot. We're going to know kind of updated trajectories from the Fed as far as their expected unemployment rate, their Fed funds rate, inflation, economic growth, all of these different things. What's the Fed signaling? Is the Fed signaling more pain to come in the economy? Is the Fed signaling a more aggressive path to cutting rates? Is the Fed signaling a soft landing, a gradual pace of reducing rates? That will be very important for markets. And then the question really is, do markets sell the first Fed cut, or do the markets buy the first Fed cut? That is a question that I cannot give you an answer to right now. History would suggest if the Fed does a 25 basis point cut, that would be good for stocks. And if the Fed does a 50 basis point cut, that would be bad for stocks. And that's why Tuesday could be so important with retail sales. Because currently we only have a 14% chance of a 50 basis point rate cut and a 86% chance of a 25 basis point rate cut. But if retail sales were to come in like really negative, it wouldn't surprise me for these odds to flip over 50% of a 50 basis point cut and to actually get a 50 basis point cut. So I don't think we can take that off the table just yet until we get retail sales. But if you were making a bet or something, the odds are in the 25 basis point camp's favor. Now, as I have showed you guys already, since 1995, anytime we've got a 25 basis point cut, you have been positive. 1 year later, in 2019, you were up 13%. 1 year later, in 1998, you were up 22.5%. And 1 year later, in 1995, you were up 21.5%. Okay, so Fed cutting rates by 25 basis points, that's good, historically speaking. 50 basis point cuts, that happened in 2001 and 2007, the first move being 50 basis points. In 2001, you were down 12.4% 1 year later, and 2007, you were down 18.9% 1 year later. And in fact, you were down 4 years later in both of these instances. You were still negative 12.6% 4 years after 2007, and you were still negative almost 5% 4 years after 2001. So there's a really bad precedence if the Fed does do 50 basis points. And I think that will be important signaling coming next week. Now, I have to say, I don't think the gains are going to be in the S&P 500. I think there is valuation resistance. I think estimates are priced for perfection for 2025 earnings. I think the areas that control the S&P do not benefit from rates falling, like big tech. Okay, big tech does not benefit from rates falling, so you could actually see some outflows to big tech, some inflows to the rest of the markets, but given the outsized weighting in Nvidia, Amazon, Apple, Google, Amazon, these other stocks, these big tech names, if you see outflows to those and inflows to the rest of the markets, you could have the markets roaring higher, but big tech selling off and the S&P would still move lower, okay? So I'm not super bullish on the headline S&P. either way, soft landing, hard landing, at least in the near term. Now, small caps, value, cyclical, consumer staples, consumer discretionary, those areas I'm a lot more bullish on. And that's kind of what Goldman Sachs' Ashish Shah just said on CNBC today. He says big returns will come from small caps while the Fed cuts rates. Take a listen to this.
Ashish Shah right now, Chief Investment Officer of Public Investing at Goldman Sachs Asset Management. Good morning to you. We saw the CPI number yesterday. We're all really waiting for what Jay Powell is going to say on September 18th. So maybe you can give us a little bit of a prediction about what it may be, but maybe what you would do about it in advance.
I got to tell you, I'm so excited because it's very rare that you get to see an easing cycle begin, and we're about to do this. So next week we're going to start the easing cycle. It's going to continue for a while. We don't know how many total cuts we're going to get. The Fed's going to have to feel that out. But I think what's important is not to focus about kind of the next week's information, but it's really setting up the playbook for this entire cutting cycle. And there's a lot of opportunity out there. But by the way, I'm really concerned that people are hanging back. They're facing this uncertainty around this election, and they're going to miss the opportunity to lock in yield, to lock in returns in the equity market if they don't pay attention.
Okay, so when you say you're worried people are going to miss this opportunity, why don't you spell out the opportunity as you see it in terms of what people could actually be doing then?
Okay, so let's start in the equity market because that's where the big returns are going to come. We all have been focused on the largest cap companies, the AI companies, and passive kind of S&P. You go into a cutting cycle, most of this interest that's being paid by companies is actually being paid by smaller cap companies, right? Those are the ones that have floating rate loans. They're going to be the primary beneficiaries in the corporate space of rate cuts, and you want to be investing in those small caps, but you got to focus on the quality. And so, when I think about small caps, it's going to represent a meaningful opportunity. You look around the corner, January, the best month for small caps is coming up. And on top of those things, I think the second half of the year, you're going to start an IPO market, which is going to create opportunity, and M&A and LBOs. And that's really critical to this space because that shrinks the space on the LBO side. It brings new growth to the space, and that new growth is going to be high quality because investors are going to be discerning this time.
But Ashish, are you suggesting go buy the Russell 2000? Are you suggesting there's certain ETFs you buy, or you're saying you have to be buying individual equities?
Yeah, so I think the tough thing about buying the Russell 2000 is there is a lot of poor quality, as we've seen, meme stocks and other things. So, I obviously I'm biased, but I prefer our ETF in the space, GSC. And that's where we really focus on quality companies that are both growers as well as represent value. But I do think you can take any really high quality small cap active strategy, and that's going to perform over the course of the next 6 to 12 months.
And what would you do with the Magnificent Seven or even the S&P 500 if you were there right now?
Look, I would do exactly what everyone in the market's been doing. You see one of the biggest withdrawals, one of the biggest outflows of large caps over the course of the last month or two. And that is because people have really gotten overweight those large caps, whether it's global investors, whether it's US investors. If you had passive allocation, you've gotten overweight this space, and it's time to diversify your equity portfolio. But by the way, there's also going to be opportunities on the fixed income side.
I do think generally that is the playbook as the Fed starts to cut rates. If it looks like we are going into a soft landing, small caps, cyclicals, value, dividends and consumer discretionary, these stocks should be able to rally substantially from here. I mean, all of those sectors have their own reasons. You can take a high-paying quality dividend stock, for an example. As the Fed starts to cut rates and those money market fund yields start to fall, then that makes those dividend stocks that are paying 4 to 6% a lot more attractive. The price of those stocks will go up and the yields will fall. So as he said in kind of the last sentence of that clip, that there is a lot of opportunities in fixed income as well. You can also take that and say the same about stocks that are quality, that pay high dividends. There's a lot of, potential there for capital appreciation in the price of those stocks. Price goes up, yields fall, but also to lock in a higher yield today in, some of those high quality paying dividend stocks. So I don't think just fixed income as far as yields, there's opportunities, but also those higher paying dividend stocks that are quality. And the thing about right now is a lot of those stocks are trading at bargain bin levels as is. Small caps and interest rate sensitive stocks, even something like Tesla, makes a lot of sense as well as rates start to be reduced. As inflation falls and Fed funds rates go down, the equity risk premium gets a lot better. So just to simplify this, equity risk premium is basically what you're expected to get in stocks versus what you can get in like fixed income or money market funds. The higher those money market fund yields are, usually the lower the risk premium. So it doesn't make as much sense to take risk in equities. But when yields fall, that equity risk premium goes up and you get paid more in theory for taking risk in equities. But really, all of this is dependent on the economy actually achieving a soft landing. If we do not achieve a soft landing, then we have problems. Kathy Jones on X writes, claims data continues to paint the picture that the labor market is softening. Initial claims rose 230,000 while continuing claims remain elevated at 1.85 million. Now, Goldman Sachs CEO David Solomon says, quote, I'm still in the soft landing camp. I think that is the most likely scenario. Take a listen to this.
I'm still in the soft landing camp. Yes, I'm still in the soft landing camp. I think that is the most likely scenario. I can't tell you that there can't be a disruption or something that can set that off, but I think we've navigated to this point where the likely scenario is we navigate with a soft landing. But certainly, got to continue to watch consumer behavior, continue to watch inflation indicators will put more pressure on consumers. We've made real progress on inflation, but we'll watch the data and we'll see how things unfold through the fall.
Now here today, we did get a new AI investor sentiment survey with bullish investors at 39.8%, neutral investors at 29.3%, and bearish investors at 31%. Here today, you do have the percent of stocks currently trading above their 50-day moving average at 46.89%. About 1.65% of all stocks today are breaking above their 50-day moving average. The 2 and 10-year yield curve inversion is still uninverted now. 2 basis points on the day today, which is now 6 days, I believe, in a row of being uninverted. This is normally the period where you're months away from a recession when you actually uninvert. So I think that is also something you should have in the back of your mind, like, hey, historically, this is not going to be a great period over the next couple of months if markets weaken, if economic data weakens. You can see today what is also notable is the RSP, the equal weight S&P, is underperforming the market cap weighted S&P. The RSP is up 0.35% and the S&P, the SPY, is up almost 0.6%. So today is another day where big tech is dominating. Nvidia is up over 2%, Google's up over 2%, Meta's up over 2%, Microsoft's now green 0.1%, and Amazon is up 0.6%. Even Apple is now green today. So we still have that heavy concentration in tech. And again, if we really are headed for a soft landing, if we do get 25 basis points of cuts from the Fed next week and retail sales comes in good and markets do not sell that first cut, then I would expect tech actually gets sold and small caps and value and dividends and cyclicals actually get bought. So I think that's where you want to be positioning now if you are in the soft landing camp. So let me know what you think about this information down below in the comments section. Provide your own commentary down there. I appreciate you guys that do that and help even in that way grow the knowledge and education for everyone. Hit the like button, subscribe to the channel if you have not done so already. If you made it to the end of this video, you might as well. It's free 99 and costs you absolutely nothing at all. You guys enjoy the rest of your day, and I will see you in the next one.